Hey guys, I'm Amit Parak and I will be taking you through some important concepts in derivatives. Derivatives carry a 5% weightage almost, so you can expect around 10 to 12 questions in the two papers, AM and PM, taken together. A lot of students tend to ignore derivatives, assuming that it carries 5% weightage, not really a big section, so you don't risk too much by dropping it. Well, I would strongly recommend that you take this section seriously. Why? Because it's an extremely rewarding section. Well, most of the content, once you're familiar with, let me tell you, you're going to find the questions fairly easy and doable. Hence, there is a good probability of scoring well in this section. I also recommend taking this section seriously because you would see a lot of derivative stuff in level 2 and level 3. So why not create a solid foundation at level 1? So let's start. I would assume that all of you would understand derivatives. It's a financial instrument. The value of derivatives would depend upon the value of the underlying. The underlying could be, let's say, a stock, could be a bond, currency, interest rate, commodity. So you could have a currency derivative, a commodity derivative, a stock derivative, and so on and so forth. So let's also look at what are the larger categories that we need to be familiar with of derivatives. Well, one way of classifying derivatives would be by way of exchange traded derivative, over the counter derivative. Know the difference between the two. Exchange traded derivative, as the name suggests, are derivatives which trade on the exchange. These are standardized instruments. There's no credit risk. Over the counter derivatives, customized instruments. They are not traded on the exchange. It's a private contract between two parties. The two parties are exposed to each other. There's an element of credit risk. Another way of classifying derivatives would be by way of forward commitment, contingent claim. So what are forward commitments? Well, forwards, futures, swaps, these would be categorized into forward commitment. Options, credit derivatives like credit default swap, these would be categorized into contingent claim. Forward commitment, where both the parties would have an obligation to each other, while in the case of contingent claim, it's only one of the two parties which is going to have a contingent liability, as it is so in the case of options, where the writer of the option has a contingent liability. Let's now deal with the pricing and valuation of derivatives. Do remember, guys, the difference between price and value with respect to derivative. Unlike assets, where the price of an asset and the value of the asset can be taken to be almost equal to each other, in the case of derivatives, the price of derivative could be different from the value of derivative. I look at the forward price. So let's say the forward is trading at $110, or let's say the future is trading at $110. Now that's the price of future. That's not the value of future. Okay. So I go and take a long position in a forward at $110. Now that's the price of forward. So after some time, the prices go up, the stock price goes up, and I'm making money on my position. Whatever money that I'm making, that's the value of my forward positions. Guys, remember, value is more of the profit or loss that you're making on your position, derivative position, while price is the level at which you had entered your position. So when you take a long position in forward, to begin with, the value of the forward position is 0. Well, there is definitely some price at which you enter and make a position. Okay, so be aware of the difference between price and value in the context of derivatives. Also remember the concept of arbitrage, replication. I'm not going to go into detail on this, but remember, guys, the concept of arbitrage is extremely important to the pricing of derivatives. Okay, when we price derivatives, we price them from a risk neutral approach. The reason being that derivatives can be combined with asset to arrive at a risk-free asset. How can we do that? Simple. If I take a long position in the stock and I take a short position in the forward, don't you think that results in a risk-free position? So I could have taken a long position in the stock at $100, and at the same time I could have taken a short position in the forward at 105. Now this ensures that I will be making $5 over a 1 year period, irrespective of what the stock price is 1 year down the line. I'm assured of a $5 return. This is risk-free return. So think of it, asset plus some sort of a position in derivative results in a risk-free position. This is essentially what we imply. Now, I could be taking a long position or short position in forward contracts, and hence what the payoffs are going to be like. If I take a long position in forward, this is how my payoff is going to be like. So if I take a long position, let's say at $105, okay, and finally the stock settles at 115. So take this example to be independent of the previous one. So I've just taken a long position in the forward at 105, and let's say the stock finally settles at 115. That implies that I would be making a $10 gain. That's good news. So your payoff is always going to be stock minus a forward price. Now, in case if the stock price is on the lower side, so let's say it's 100, I end up making a loss of $5. Had I taken a short position in forward, this is what my payoff is going to be like. So rising price, bad news, falling price, good news. Again, your payoff is going to be the difference between the stock price and the forward price. Of course, here you take F minus S. So if I've taken a long position at 110, the stock finally settles at 120, I've ended up making a loss of $10. It's 110 minus 120. Okay, so falling price, bad news if you've taken a short, good news in case if you've taken a short position, bad news if you've taken a long position, because in long position, falling price would replicate into losses. So depending on the view that you have on the underlying, you either go for a long or a short position. How do I arrive at forward price? There are a couple of expressions. A lot of students find the second expression to be a little difficult. So let me just try and explain it, try to simplify these expressions. Remember, for a non-dividend paying stock, and I'm taking the example of a stock, let's say which trades at $100 and it's non-dividend paying. So the 1 year forward position or the 1 year forward price, if the risk-free rate is let's say 5%, is going to be 100 into 1.05. As simple as that. So that's how I arrive at my forward price. But then let's consider another underlying, which is currently trading at 100. Okay, and 6 months down the line, it is supposed to pay a dividend of $5, and I need to find out the 1 year forward price. How would I do that? Well, I'm going to take 100. I'm going to reduce the present value of $5, which is the dividend, which is 6 months due from now. Okay, so the present value of $5 is going to be reduced from 100 because that's the effective stock price for me. I'm not going to be eligible for $5 dividend because I've taken a long position in forward. So what is the price that I would be willing to pay for the forward? It's going to be this amount into 1 plus R. So let's say 1.05. Okay, so the 100 minus present value of 5 into 1.05. In general, guys, do remember when I arrive at the forward price, I take into account the underlying price, I add interest cost to it, I add storage cost to it, I reduce dividend, I reduce convenience yield. So that's something that you got to keep in mind when you arrive at the price of forward. How would I arrive at the value of forward contract? Well, before expiry, if you want to arrive at the value of forward contract, this is how you would do it. So let me take an illustration. So you've taken a long position in forward with the forward price being 105. Okay, and it's a 1 year forward that you've taken a position in. And this is the approach that I recommend to most of my students. So 105 is apparently the price at which you had gone long forward. So I'll term it as F, which is 105. Now 6 months into the contract, you see that the stock price has gone up to as high as 120. And if somebody were to ask you, hey, what's the value of your forward? You would say it's definitely positive, but how much? Let's compute it. Now, based on a stock price of 120, what shall be a comparable forward price? Let's call it F star. You would say, well, 5% is the interest rate. And let me just roughly take 2.5% to be the effective rate for 6 months. Okay, so that would essentially mean that on 120, your comparable forward price is going to be 120 into 1.025, which makes it almost 123. So while I had taken a long position at 120, the comparable forward would now be trading at 123. So I have an advantage to the extent of, okay, I stand corrected. While I had taken a forward position at 105, comparable forward positions are available at 123. So which clearly represents an advantage of $18 which is being enjoyed by me. This $18 advantage is something that I would enjoy at this point of time. So my gain is F star minus F, which is 123 minus 105, which is 18. And this is the gain that would expectedly come to me at this point of time. Let me just find out the present value of it over here. So the value of my forward contract is going to be 18. The present value of this, so it's going to be 18 divided by 1.025. Okay, so that's how we would derive at the value of the forward contract. So let me restate the steps that you're going to take. Be mindful of the forward price at which you had entered the position. Try and arrive at the comparable forward price based on the prevailing stock price. And let's say if there are any benefits or costs that is going to kick in during the intermediate period, that as well needs to be adjusted in when you arrive at F star. Get the difference between F star and F and then find out the present value of it. That would give you the value of your forward position. This approach works well irrespective of the kind of forward that you work with. It could be a currency forward. It works fabulously well. And you could have various elements to grapple with: convenience yield, dividend yield, or let's say storage costs. I think it's fairly easy to implement all that when you take up this approach. Let's now move on and look at swap. Well, all of us understand that swap is a contract where you have two parties agreeing to exchange interest payments over a certain period. And there are going to be multiple exchanges. So let's say if you have a 3-year swap with exchanges taking place every year, so it's a 3-year swap. So you would see that the exchange would take place at year 1, the exchange will take place at year 2, and the exchange will take place at year 3. And the exchange that would take place is largely based on the interest payment. The principle is going to be notional in nature. So we are talking about interest rate swap. One leg is going to be fixed rate, the other leg is going to be floating. So the net payment would be made by one party to the other. And what's going to be the net payment? The net payment is going to be the fixed rate minus the floating rate. Okay, so let's say if the fixed rate is 5% and the floating rate was taken as LIBOR. So while one party would be paying 5% to the other party, the other party is going to pay LIBOR, and this LIBOR is going to be based on the 12-month LIBOR that stood to begin with. So let's say the 12-month LIBOR to begin with stood at 4%. So you would see the other party paying 4%. Now at this point of time, the 12-month LIBOR stood at, let's say, 6%. So you would see the other party be paying 6%. Of course, the notional principle, let's say being 100, you would see one party paying 5 and the other party paying 4. So net you would have one party paying 1 to the other. So clearly these two payments will be netted. Okay, and the net payment is essentially going to be the difference between the fixed rate and the floating rate. Okay, so now let's move on to options. And just another important point with respect to swaps. Many times we consider swap as a bundle of forwards. Well, it is absolutely fine for you to consider swap as bundle of forwards, because forward would involve one exchange, while swap involves multiple exchanges. So we might as well consider swap as a bundle of forwards. But unlike a forward which will have a zero value, the bundle of forwards which a swap constitutes, okay, all those forwards might not have zero value to start with. Okay, so let me repeat myself. I can consider swap as a bundle of forwards, but those forwards will not have zero value. Okay, some of them would have positive value, some of them would have negative value, and when you bundle them together, they have a zero value, and hence the value of the swap to begin with is zero. But a standalone forward contract, when we talk about, will always have a zero value to start with. Okay, unless and until we take the price of the forward to be different from what the fair price is, then it's of course a different story. Now move on to options. The two types of options you need to be aware of. One is call, the other is put. Call option, what's going to be the payoff? Remember, call option is something that I will buy when I have a bullish view on the stock, when I believe that the stock price is going to go up. What's going to be the payoff of the stock? As a buyer of the call option, my payoff of the call option is going to be whatever is the stock price at the time of settlement minus the strike price. Okay. Now, in case if the stock price is below the strike price, it's not that I need to give the amount, because I mean, thanks to an option, if I own it, either I receive something at the time of expiry or else I don't give anything. So the worst situation is when I don't get anything, but I don't need to give anything. And the good situation is when the stock price is above the strike price. So clearly this is going to be the payoff of a call option. Okay. Let's now move on and look at the payoff of the put option. Well, put option is something that I would go ahead and buy in case if I believe that the stock price is going to go down and go below the strike price. So this is the payoff that I would be eligible for, X minus ST, where ST is the stock price or the underlying price at the time of settlement. In case if the stock price is above the strike price, well, the payoff is going to be 0. So this is how we arrive at the payoff of a put option for the buyer of the put option. Remember, all derivatives are zero-sum games, and so is it so in the case of options. So if one party makes some payoff, if it is positive for one party, it's going to be negative for the other. So if the buyer of the option ends up making some positive payoff, the writer of the option makes a negative payoff to that extent. Always a zero-sum game. The other terminology that you need to be aware of is the moneyness of the option. So is an option in the money, at the money, out of the money? So talking about call option, as long as the stock price is greater than the strike price, we would term the option as in the money. If the stock price is equal to strike price, it's an at the money option. And if the stock price is below the strike price, we would term it as out of the money option. Similarly, for put, in case if the stock price is below the strike price, that's when it's in the money, right? Because that's good situation to be in, and hence you would term that option as in the money. Remember guys, the payoff of a put is X minus S. Okay, so as long as S is less than X, well, you would have some intrinsic value for the put, and hence you would term it as in the money. At the money when S is equal to X, and out of the money when S is greater than X. The other important concept that you need to be familiar with is the PutCall Parity. Okay, and we would have it on the next slide. Before that, let me just try and put that PutCall Parity before you. Put plus stock is equal to call plus the present value of the strike price. So this is one portfolio, this is the other portfolio. Essentially, we are trying to argue that the cash flows or the payoff of this portfolio will always be equal to the payoff of this portfolio. And if that be so, the value of these portfolios today should be equal to each other. Because if the payoffs of these two portfolios are always going to be equal to each other, irrespective of the circumstances, well, then the value of the two portfolios should be the same today as well. Okay, so P plus S is equal to C plus the present value of the strike price. So put plus the stock. So stock is what I'm considering as the underlying. So there is this one party which goes out and buys the put and buys the stock. So it has created a protective put portfolio. The other party goes ahead and buys a call and buys a zero coupon bond with the face value of X. Then the two parties are going to have exactly the same payoff. This is known as a protective put portfolio, and this is known as the fiduciary call portfolio. The payoffs of the two portfolios are going to be equal going forward, and hence the value of the two portfolios to begin with should be equal. So that's the underlying logic for PutCall Parity, and essentially out here on this table we are trying to establish that the payoffs of the two portfolios are going to be equal irrespective of whether the stock price is greater than the strike price or is below the strike price. Remember, the put and call that we take are for this stock, and the put and call that we take belong to the same series and have the same strike price. I reckon that PutCall Parity is clearly the most important concept that you need to keep in mind for CFA level 1 derivatives section, because this is a highly testable area. There could be a lot of interesting questions that can be created around PutCall Parity. So let me just try and explain you certain things that you need to remember with respect to PutCall Parity. One, of course, is the expression itself. 2, what kind of question can you get? Well, there could be a situation where they would give you the price of the put, they would give you the price of the stock, they would indicate the strike price, and they would ask you to arrive at the value of call, or let's say the price of call. Okay, you would be able to do that because you know the expression, you know P, you know S, you know X, you know the risk-free rate. So it's pretty easy to arrive at the value of call. Okay, the other question that you might get is how to create a synthetic position. So let's say we know that C plus the present value of the strike price is equal to P plus S. That essentially implies that C is equal to P plus S minus the present value of X. In other words, I can replicate a call by taking a long position in this put, taking a long position in the stock, and taking a short position in the bond. Now, when you sell a bond, you short a bond, it is essentially equivalent to borrowing money. So guys, remember, when you take a short position in the bond, it's borrowing money. So you would say, hey, I can create a synthetic call by taking a long position in the put, long position in the stock, and by borrowing money. Okay, let us try another synthetic instrument that we can create out of this PutCall Parity. So how would I create a synthetic put? A synthetic put is going to be equal to C plus PV of X minus S. In other words, I can create a synthetic put by going long on call, by buying a bond. Buying a bond means lending money, and by selling the stock. So, pretty nice way to create synthetic position. Can I create a synthetic position which replicates a position in the stock? So, synthetic stock, one would say yes, S is equal to C plus the present value of X minus P. So, I take a long position in the call, I take a long position in the bond. In other words, I lend money and I sell a put. So, that helps me create a portfolio which is going to replicate the payoff which otherwise a simple stock position would have given me. So guys, do remember, you might get questions which might expect you to create synthetic position. Well, the other context in which you can be tested is where they would give you the values of all these 4 components. So they'll give you C, they'll give you X, P, S, RF, T, everything. Okay. And they would seek some sort of a view from you based on, of course, the 3 options that would be given in the paper, where they would ask you whether there is an arbitrage and how do you exploit the arbitrage. It's going to be pretty simple. So you're going to place this side of the expression LHS and RHS, which is P plus S. See whether the LHS is equal to RHS. If it is, then there is no arbitrage. If the two are unequal to each other, there is arbitrage. Okay. So how would you exploit the arbitrage? So let's say for once, I assume that C plus the present value of the strike price is lower than P plus S. Okay. So when you create an arbitrage strategy, you always buy the cheaper side and you sell the expensive side. Since P plus S is greater, I'm going to sell this. And I'm going to buy this. So I'm going to buy the call, I'm going to buy the bond, I'm going to sell the put, I'm going to sell the stock. Okay. Again, remember, buying the bond means lending. So you just need to be familiar with the kind of positions that you take, and hence I think you will be fairly comfortable taking the right option. So as you would realize, PutCall Parity, extremely important. Now coming over to options, the lower bound, the upper bound. There are 2 types of options that you need to be familiar with. One is European and the other is American. Well, European option, American option, nothing to do with geography. European options can be exercised only on the day of settlement. American options can be exercised on settlement or before settlement. So remember, American option, if at all, will have a value greater than the European option. Okay. Coming over to the lower and the upper bound. To remember that the value of an option can never be negative. So let's say if I'm talking about a call, and let's say to start with, I'm talking about European options, and let's say a call, the call value will always be positive. So it will always be greater than equal to 0 or the stock price minus the strike price. That's how we understand the payoff of the call. So it should be stock price minus the strike price. But given that the strike price is something that would come into play only at the time of settlement, while the stock price is the prevailing stock price, these are not strictly comparable numbers. So stock price is today, the strike price is what comes into play sometime later. So I'm going to take the present value of the strike price just to make these two numbers comparable. So the lower bound of the call option is going to be this. So it's going to be greater than or equal to 0 or S minus the present value of X, whichever is higher. For put, similarly, it's going to be max 0, comma, PV of X minus S. All right. Now let's look at American options. What is going to be the payoff? Now let me put it on this slide while you do have it on the next slide. This is how the lower bound of an American option is going to be like. Let me just try and compare it with the European option. And remember, for American options, your call will be greater than max 0 S minus X. A lot of people tend to make this mistake. They would say, hey, an American option can be exercised anytime. So this strike price can very well be put into play today as well. Now, but when you do this, you realize that the lower bound of an American option is lower than that of European, which should not be, because an American option, if at all, will always be greater in value than the European option. So you might as well take it as PV of X. While in the case of put, you might just want to take it as 0, comma, X minus S. Going very much in line with our understanding of American option, it can be exercised anytime, and hence X minus S, and X minus S is greater than PV of X minus S, which is fine because an American option could be greater than the European option in value terms. So the lower bound of an American option could be greater than the lower bound of a European option, and that is so in the case of put. Alright, so now we move on to binomial option pricing. Very important. How do I price option? And let's say I take a binomial approach. I'm going to take a very simple example to explain it. So let's say you have a stock which is currently trading at 100. Let's say it can move to 125. It can come down to 80. Okay, so this is the 1 year period, sort of a forecast that I'm trying to make. Of course, there's a probability of 100 going to 125. There's a downside probability as well. Let's say I'm not aware of those probabilities. Let me tell you, those probabilities are not really of any interest to me. Those are real probabilities. Remember, when I try to value options, I need risk-neutral probabilities. How do I arrive at those risk-neutral probabilities? Let me show. So let's say I'm talking about a call option which has a strike price of 100. Now you realize that when the stock settles at 125, the value of the call is going to be 25. When the stock settles at 80, the value of the call is going to be 0. Okay, so what shall be the value of the call today? Given that these are the two possible payoffs, you will say if the risk neutral probability of an upside is P and the risk neutral probability of downside is 1 minus P, in case if I'm able to find out P and 1 minus P, it would be easy going. How do I arrive at P and 1 minus P? In case if you find these expressions to be a little difficult to remember, finding out P, which is essentially what pi here stands for, I can do so by taking P and 1 minus P over here, and then based on this I can argue that 100 is equal to 125P plus 80 into 1 minus P, alright, divided by 1 plus RF. Let's say RF is 5%, so 1.05. This will help me arrive at the value of P. So let's work it out. So this is what we get the value of P as, 5 by 9. And if this be so, then I know that this is 5 by 9, this is 4 by 9. So what's going to be the value of the call today? Well, C is equal to 5 by 9 into 25 plus 4 by 9 into 0 divided by 1.05. Do observe that I'm discounting it at the risk-free rate because I've used the risk-neutral probability, and hence we can very well afford to discount it at the risk-free rate. Now that's risk-neutral approach for you. Okay. In case if I would want to find out P directly, I can very well do so. And this is how we arrive at it. P is equal to 1 plus RF, which is 1.05 minus D, where D is your down factor. Now you see that 100 goes to 80, so the down factor is 0.8 divided by the up factor minus the down factor, which is 1.25 minus 0.8, which again gives you 5 by 9. Okay, so either you remember this expression, which again is pretty easy to remember, or else you try and work it out yourself. Well, the other important concept is that of hedge ratio. Let me just go back to my earlier example where I said you have a stock, it can go to 125 and it can come down to 80, and you have this call which could go up to 25 or come down to 0. Okay, and so you have this call with the strike price being 100. If I want to find out the hedge ratio, which also is known as the delta, how would I do that? Well, it's going to be 25 minus 0 divided by 125 minus 80, which gives you 25 by 45, which is 5 by 9, which is nearly 0.55. Now that's the hedge ratio. What does it imply? This implies that if I have taken, let's say, 100 calls, I can very much hedge my position of a long position in 100 calls by going short 55 stocks. 55 shares. 4 types of option strategies that you need to be familiar with. One is long call, the other is short call, long put, and short put. Well, these are the 4 simple option strategies that you need to be familiar with. Well, you can of course reduce this count from 4 to 2, because once you know the payoff of long call, it's very easy to arrive at the payoff of short call, because it's just going to be the opposite of it. Okay, so how would we understand what is going to be the consequence when I take a long call position? Instead of troubling yourself with all these expressions, I think try and work it out logically. Okay, so let me just take an example. Let's say if you've gone long call, strike price being 100 at a premium of $5. Okay, and so if somebody were to ask you, hey, what's your break even? Now my break even is going to be when the stock finally achieves a price of 105, because that's when the payoff of this call is going to be $5, just good enough for me to recover my premium cost. Okay, so this becomes my break even point. Okay, beyond 105 is when I start making really some good money. So let's say if the stock price ends up at 110, you would say 110 minus 100, $10 is going to be my payoff minus my cost, premium cost. So that turns out to be $5. That's going to be my profit. What's going to be my profit if the stock ends up at 120? 120 minus 100, 20, not to forget the premium. So 20 minus 5, 15, and it's going to be my profit. So whatever is the profit of a call buyer, well, to that extent is there going to be loss for the writer. So that's how we would look at things. And be very, very careful when you read the question. Are they talking about call buyer or call writer? I always suggest that look at things, think about your positions from the perspective of a long call. And in case if the question is about a short call, just then conclude the opposite. Okay, so as a call buyer, you end up making a profit of $7. It's implied that you are making a loss of $7 when you write the call, or as a writer of the call. The break-even point is going to be the same for a long call and a short call position. Okay, now let me move on and take another example, which is going to be about put. So let's say if I have gone long put with the strike price $100 at a premium of $6, what's going to be my break-even? My break-even point is going to be $94. Declining stock price is good news for somebody who's bought put. At $94, the payoff of this put is $6, just good enough for me to recover the premium. Any price below 94, that's going to be my gain. So in case if the stock settles at 90, 100 minus 90, $10 is the payoff, not to forget the premium that I've incurred. So $4 is going to be my profit. In the case of short put, well, your profit is going to be exactly the opposite of the profit of the long put. So in that case, it's going to be a loss. So if this chap is making a profit of $4, the short put guy, the writer of the put, is making a loss of $4. The break-even point is going to be the same for the long put and the short put. The other couple of strategies which you need to be familiar with, one is covered call, the other is protective put. So what's covered call? I take a long position in the stock and I take a short position in the call. And in the case of protective put, I take a long position in the stock and I take a long position in the call. Okay. Again, you can expect questions where they would ask you the break-even point, the profits out here. So let me just take an illustration. So let's say you'd gone long stock at $100 and you had shorted a call, sold a call with the strike price $110. Now that basically means that this gap of 100 and 110 is something that you can enjoy in case if the stock price goes up. So let's say the stock price settles at 108, you end up making $8 on your long stock position, but then you also realize that you had sold the call and let's say you had sold it for $2 premium. So this again is your gain. Okay, so what's a break-even point in this case? If I have spent $2 on buying the option, I should at least be making $2 on my stock. So you'd say, okay, at 102 is when I make $2 on the stock, and that is just good enough to recover my premium cost. So 102 becomes a break-even point. Anything beyond 102 is going to be a gain. Your maximum gain is going to be $8. Okay, coming over to put, protective put, I could have gone long stock at 100. I might have, it's not long call, it's long put. So I will go long stock, long put. That's protective put strategy for me. So I'd gone long $100. And let's say I'd gone long put with the strike price $90. Now this creates some sort of a floor. So guys, remember, if this is the put that I bought for, let's say $3, okay, or let's say $1.5, right? Then what is my maximum loss? You would say from 100 to 90, $10 is the maximum loss. You are protected beyond 90. Below 90 you are protected thanks to the put that you bought, but not to forget that you had paid a premium of $1.5. So your maximum loss is going to be 11.5. What's going to be my break-even point? Since I had spent $1.5 buying the put, if the stock goes to 101.5 and settles there, well, that's going to be my break-even point, 101.5. Okay, so that's how we are going to analyze the covered call and the protective put strategy. Well, apart from that, guys, do remember the variables on which the option value is going to be sensitive to. One is the underlying. So let's say in our case, we'll take stock as the underlying. The other is the volatility of the underlying. Okay. The third is the time to expiry. You have the interest rate. Well, these are some of the variables which are important. If the stock price goes up, the call value will go up, the put value will go down. If the volatility goes up, the call value will go up, the put value as well would go up. Longer the time to expiry, greater shall be the value of call, greater shall be the value of put, except a few exceptions where a put value could actually go down under certain circumstances. Okay, so let me just qualify. When you have deep in the money put, you would rather want it to have a shorter time to expiry because you're in a hurry to exercise it and take home the money. Okay, so that's when you might have an inverse relationship between the value of the put and the time to expiry. Interest rate, greater the interest rate, greater shall be the value of call, lower shall be the value of put. So these are some of the relationships that you should be familiar with. What is there in store for you as far as derivatives are concerned, as far as derivatives as a section is concerned? I hope you guys must be feeling much more confident after this session. I wish you all the best.